Hi Warriors, goodinvesting.com Thursday. How's everyone doing today? Hello Patrick. Who else is in the house? Kenneth and Niraj wants to know about the Nifty 50. So I'm sure Steve will cover that for you. As you can see, we have some nice pattern and plays working. What's unique about ForexAnalytix is that we have different methodology. For example, on this trade, Andre sees a harmonic pattern in US dollar MEX, and Blake using conventional, basic technical, sees a descending wedge. So, it's really compelling when two different methodologies line up, see the same thing, different targets, different entries, but to me that's confluence of the team. Greg is looking for another new high, substantially higher in euro. Don't fade Greg or Horvat. Do it at your own peril. And Stelios has a great entry and a nice trade working in Aussie Kiwi. One thing about Stelios is, for example, I made the tough money buying it under 105 and getting out at 560 to 580, and here we are at 106.80. So I'm actually going to ask Andre about using a trailing dynamic stop. So when I take partials, I'm still there for the easy money, which is starting to develop here. And these are guidelines. For example, if your style is you're in the money now, you could bring your stop up to break even wherever you got in. I'm sure Stella probably considering it, but he's looking for 113 down the road. Okay, I just want to show this tweet here. Yesterday afternoon, I tweeted out because I've been looking at the Swiss for a position trade. I want to teach people how to hold a position trade, not just scalp, and said look at 97.12 for a short, 61.8 back, potential third drive on 1 hour, and that's my animal spirit, the Eagles, and it goes along with a group that I work with on Saturday mornings. And here's a picture on the Swiss. I'll clean it up next time. It didn't get to 12. The high was 97.10.90, off by 1.1 pip on that. So it still has a lot of work to do to show that it's negative. I mean, we have the beginnings of a potential reversal day, but we're still up about 70 pips on the week. But it's Thursday. A lot could happen between today and where we close tomorrow. Ideally, I'd like to see it close lower on the week. We'll need a pretty good euro rally for that to happen. But that's the picture. Daily. 4 hours showed pretty good divergence too. Look at this, didn't even get to 70 at this high. So well under this, well under the last peak here. So some pretty glaring divergence. Maybe we're going to get this thing going to the downside. Be nice to see it take out. Here's really a sign that'll tell you that there's something wrong with Swiss. Would be it taking out, trading back below last week's high and the week before high. So we need to get back under 96.50, 96.44, and then this breakout will be negated. So that's my view. I'm not going to cover a lot of stuff. How are you, KT? Because we have a great team here, and I'm interested in seeing what Blake has to say. Of course, a lot of people are excited about the metals. I'm going to let Steve cover that too. But, that gold-silver ratio that I've been talking about for a month or so really started to come in yesterday. And, some people are lining up trades by having short positions on GLD and long positions on SLV. And, and I heard a great reason for it. The government doesn't care about the price of silver, okay, because you know, it can be aberrational. It's not like what gold, the message gold would give the markets if it started flying. So there's definitely going to be more paper selling in the gold that's showing up now, and maybe central banks and governments don't care about the price of silver. So the war on gold continues, but maybe they're, you know, just going to let silver find its level. So interesting concept. Oh, the Hunt brothers, yes, yes. They weren't a government agency, though, Tom, and it tells me, you know, that you're from my generation. Okay, so I was in the markets at that time. I remember that. So that's it. Let's see how this works out. And, you know, really, here's the Aussie. This is what I was talking about, Aussie Kiwi, making the tough money down here. You know, tried it here, worked for a little, tried it here, worked for more. But, you know, 70 pips with nothing on, because I thought we might pull back to, you know, the wedge line when we were in here. But it's looking good. Actually, my longer term target, and we're not that far away, would be from where you anchor the wedge line. Up here looks like 760. So you got to buy any break. Any break's a buying opportunity. I think we have at least 107.60 in it. Maybe we'll get some type of right shoulder from this resistance, get some type of pullback. 560, 580 would be nice. A little bit underneath where I got out. So here's another guy who knows how to make the tough money, and occasionally is there for windfalls. So how do you do it, Blake, when, you know, you and I like this pair down here, and I know you booked it. Were you able to recommit and catch the windfall?
Yeah, and yesterday I closed out the pattern in play at 106.41.
Oh, that's
I think.
Nice.
Yeah, because you know, we had CPI data and Australian employment, and it wasn't, you know, at that point in time, it's like, okay, well, there's so much data coming out, and I wasn't going to be in front of the computer, so I had my son's baseball game, so you know, hey, the Aussie New Zealand, it's really trying to, you know, I have to let me grab it really quick.
Okay,
I don't think right at this moment in time, when you start talking about risk reward, you know, near term, this is the right place to be buying. We're approaching channel highs. Okay, you can see this the channel high right here, and I've made some really good money being on the long side of the Aussie New Zealand the last week and a half. Predominantly, one of the things that really turned the corner is and I shared it with all the guys and gals in the chat room. City Tech went, they put out a really bearish report on the Aussie New Zealand that day, that last red candle right there, and so I'm like, you know what?
Fade, huh?
No, it was just like they were restating and rehashing a bearish case that they've had since.
They were like being reporters instead of forecasters.
Well, they've been reporting the same, you know, bearish case for like, you know, months, and same stuff they've been arguing since down here. And I sent an email to, I told everybody in our chat room, I told everybody in our office. I was like, hey, this is, they're gonna get, you know, I think their timing's off here, and you know, overall, from a, you know, risk reward perspective, we were down at this multi-year trend line down here. So it's like, okay, well, I would rather be on the long side than the short side, as we were, you know, near the 105 level. Now, it obviously we've rallied quite substantially since then. We've gone from 105 to 106 and change. You know, it's been almost a 200 pip move, and I don't know if this is the right time to be long, but what I would look for in the next week, hopefully, is we get a drop back down towards, you know, the 106 level, to open up an opportunity to be on the long side. And will we get down there? I don't know. Holy cow, man, this market is moving all over the map. What just happened? Wow, there's a lot of volatility in the dollar CAD. It just went to the 85 to 126 and change. The pound spiking all over the place because of this Takeda says Shire rejected pound share offer, so the pound's getting all jiggy too. A lot of volatility happening right at this very moment. Now, before I get too deep into what's happening here, I have to point out that today there's a crap ton of euro options expiring. So here, let me see if I can. I'll grab some. Let me grab a little snippet so you guys can read.
Let me guess. 124 is where there's a lot of open interest. 123 and 124.
This is. Hold on. Okay, this is from yesterday. This is via a Bloomberg chat between us at the office. So the euro expiries tomorrow, only serving to help this sucker stuck in the mud. 124. There's 1.3 billion expiring at 124 this morning at 10 a.m. Eastern. Let's see. There's at 123.85, 600 million, 123.50 to 123.60, 1.1 billion, 123.15 to 123.25, 1.3 billion, and 123 to 123.10, 2 billion. So
these are calls.
These are different options, whether it's
puts or calls, both.
Yeah, usually there's some sort of binary option.
Okay.
So the point is that we're probably going to be hovering around these levels until 10 a.m. Eastern, and with the euro dollar, you could see we're pretty much I would say, and that's a 5-minute chart, so let me go back to an hourly. We're pretty much trapped here, and I would imagine that we're going to stay trapped in this area until 10 a.m. Eastern. So we're probably going to start moving out of here after that. Now, which direction? I mean, if I knew that, I wouldn't be here with you guys right now, because it'd be. But I think that we can all agree that that this euro is consolidating and getting ready for a pretty big move, and hopefully things will loosen up today, because I tweeted yesterday, which I tweet quite a bit normal. I tweeted, I haven't been tweeting a lot because there's just nothing to do. It's an extremely frustrating market right now, with just not a lot going on. And in order for the market to really loosen up, in my opinion, the euro dollar is going to have to break above this little trend line here, which comes in around 124.30, or below 123, which is this year-long trend line that we probed it a couple of weeks back here, but we really got to get below 123. So 124 and change, 123, and until we start making our way out of that range, I don't know if there's going to be a whole lot to do. I assume the market is going to loosen up soon, and we're going to start to see some decent activity in the market, in the FX market. FX volatility has been very light as of recently, and which is surprising considering the volatility that we've seen in equities. It hasn't really translated to currencies, but that doesn't mean that it won't pick up, and it will. One thing that I've learned over the years, Dale, and I'm sure you have seen this too, is that
I'm a newbie.
yeah, you're about as new as my my grandfather's Italian.
Be careful.
But one thing that we've learned is that the market only will stay complacent like this with low volatility for so long. and things will break out, especially this time of year. It's not like this isn't like a seasonal type of time of year where we're like, okay, you know, market's not going to do anything, and because it's July. This is a time of year when we tend to have a lot of volatility, so things are going to pick up very shortly. It's been a frustrating couple of weeks that we haven't seen anything happen. Actually, you know, I'd say a couple of weeks, but if you look since March, I mean, we've been stuck between 122 and 124 in the euro dollar for a long time, but things will loosen up soon. And you know, whether it's a continuation of dollar weakness, which most people assume that's what's going to happen, or we start to see a full-on dollar reversal, it's to be seen. But I think volatility will be picking up really soon in the currency market. So just, you know, stand by. Whether it's today after all of these options expire, or it's, you know, next week or the following week, who knows? You know, one of the guys in our chat room, relatively new trader in our chat room, he I think his name's DJ, or excuse me if I got that incorrect, because I haven't seen him all that often. He's like, you know, May is typically seasonally a good month for the dollar index, and I haven't looked into that, so we can actually take a look at, you know, May of every year, and let's see, this would be this is May, and we did see a rally back in 2016. May 2017 was not. Was a down month, but I guess you could probably go through all the May instances and see how the dollar's done, and I'm going to take his word for it, even though I'm not, you know, actually doing the homework right at this moment. I need a little bit more time, since I've only been up for like the last couple hours, and it's still 5 in the morning here. So, but I do feel that the dollar is going to loosen up here. You just gotta be patient. You do have to be patient. Now, you did talk a little bit about the dollar Swiss. You know, I want to mention that because, first of all, great call, Dale, on the dollar Swiss. I actually had a pattern in play. I closed it this morning because it's not because of the dollar Swiss, although the dollar Swiss did hit the 618, which, you know, is significant. But do you know what else happened in with the dollar Swiss today? Dale? He's not here. Okay, so that's okay. What else happened with the Swiss is actually the Euro Swiss. If you guys haven't seen what the Euro Swiss has done, the Euro Swiss had basically filled the gap from the 120 floor of the Swiss National Bank when they you know, removed the floor in the Euro Swiss, and we had the Swiss National Bank debacle. We actually closed that gap today. All right, or you can say, for all intents and purposes, half. We basically hit 120, or really close to 120. So now this goes along with a couple of different thoughts that I've had. First of all, I thought the dollar Swiss would make it up here, and unfortunately that spike happened just as I woke up this morning. I kind of missed it, and then I basically just got in front of the computer when all this happened, this big move in the dollar Swiss. Okay, and you can see a very similar move in the Euro Swiss as well. Okay, right here as we, you know, saw a lot of volatility. Now, does that mean the Euro Swiss is done? I don't know, but if you look at stocks and you go over to the equity markets, the equity markets have had a pretty nice move higher in recent weeks. In the last 2 weeks, we've had a nice move. We're at a 618 retracement in the S&P. We're getting close to a, you know, downtrend line. You look at the, you know, the Dow. We broke above that trend line, but we've extended almost 127% extension of the last move down. The NASDAQ has had a move to the 618. If stocks do start to show a reversal here, which I'm assuming that after having a couple of weeks of a relatively good move in stocks, what could happen as we see a little bit of selling in the stock market here, the Swiss franc might actually garner a little bit of strength as a result. So you know, you got to be careful with the Swiss pairs, and that's why I'm like, okay, it's better to be safe than sorry, and just take the dollar Swiss off, as you can see here on the pattern in play. Even though we had a bullish wedge pattern, here's the dollar Swiss. Even though we had a bullish wedge pattern, and it still could extend further. You know, the risk of maybe some risk off here is a little higher. Now, what else was I going to say this morning? The dollar Canadian, I am long, and I'm still long, very frustratingly long, by the way. I've been long this thing for the last basically for the last week, as we've been down here below 126. We closed right at the 200-day moving average. We saw a little bit of selling this morning. We came back down to the 618 retracement today. The dollar Canadian, I'm only going to feel comfortable being long the dollar Canadian if we get back above 126.30 today. So we've got a lot of work to do here for me to get excited about it. But you know, if the market does see a little bit of risk-off activity, you know, the Canadian yen, which has been a pretty strong move, and we've seen this this is a completion out of a triangle formation. If you guys haven't seen why the dollar Canadian stopped where it stopped, there's your triangle formation. Expectation out of the triangle formation was complete. We had 161% extension complete. Previous support, current resistance complete. So the dollar, or the Canadian yen, should start to show some reversals here. And like I said, if stocks, which by the way, futures are hitting lows right now, if stocks continue to move lower, the Canadian yen would move lower. We'd probably see the dollar Canadian firm up after that as well. My colleagues Steve and Stelios and I think Grega and Andre are both going to be, or all going to be adding some technical information to a blog post that is going out about this, about the precious metals. So I'm going to go ahead and steal their thunder, and let's talk about all the precious. I'm joking, Steve. Joking. I'm gonna leave it for you. Joke. And you too, Stelios. I'm not going to steal you guys' thunder, but a big blog that the team has written is coming out regarding regarding precious metals. I didn't have anything to do with it. These guys are all done it themselves, and it's a pretty good write-up. So you guys be looking for that. It is going to be on our blog section on the free part of our website. One last thing,
there, Blake. I'm gonna put the link in the chat box. Yeah.
Oh, great. Well, fantastic. So I'm sure everybody's going to be looking forward to reading that. So let's go ahead and look at all the precious metals. I'm joking. One last thing I want to talk about is crude, and I know Steve and Stelios are probably going to talk a little bit more at length about crude. But what do you guys make? What do you guys make of this move in crude?
Personally, I expected it since some time ago. I was covering crude every day here in the webinar, Blake. My targets were 69, and if we go above that, 72.
Okay, but okay, fine. We got there. Congratulations. But why with the move higher and then a possible false breakout and then a push back below the breakout point, this crude move hasn't made a whole lot of sense to me. So
we didn't actually close. I mean, we did see an intraday move that was pointing to perhaps a false break. But if you actually draw the line, passing exactly from the previous high, you'll see that on a daily closing basis, we didn't actually close below the broken trend line. So I don't think there was any technical damage done there during that day on a daily closing basis, at least.
Maybe I'm just looking at it, the way I was looking at it was wrong, because I was looking at it as a bullish wedge, and then we had a false breakout above the wedge highs, and then we actually had a day of selling. Then we created a hammer, and after the hammer, I knew at that point that we're going to go higher. But this move in crude, And then I guess the other problem in crude oil is Dennis Gartman got short. Yeah, and that's that probably did it in for the crude bears.
The absolute contrarian indicator, right?
Yeah, so it which he's very well known for, obviously, and I hate to bash people publicly, but that guy deserves it because he's consistently wrong, and he continues to be on CNBC, which if I lived in New York, which I don't, obviously, I wouldn't want to be on CNBC. The guys that I trade with, none of them have any desires to be on CNBC either. Because these guys they do it, they make it. One of the guys that I trade with managed many of billions of dollars for over 20 years. So, when we as a group see, people like that on CNBC, and you're broadcasting out to a very wide audience of, sometimes, getting the market trapped. It's like you take note of that because it's well, for him, it's a pretty much an anomaly almost that I don't know how wrong you can be all the time. But anyway, and they keep bringing him back, but I think they keep bringing him back because it draws viewers, because people want to know exactly what he's doing to fade him. So I don't know. It's interesting nonetheless. But hey, I have to get out of here for the data that's coming out. We do have now, Canadian ADP, this is relatively new, that having ADP doing private employment on the Canadian economy, but we also have Philly Fed and unemployment claims that are coming out as well. And just keep in mind, as I turn it over to you guys, that we have a ton of options that are expiring at 10 a.m. Eastern, so the market might be a little trapped until then. So with that being said, I'm going to pass it over to you guys. I hope you guys have a great trading session, Steve and Stelios and Dale.
Thank you, Blake. You too.
Good hunting, bro.
All right, thanks, guys.
How are you today, Steve?
I'm good, Dale. I'm good. How have you been?
Good, very good. Looking forward to speaking with our guest today, Bob Iacchino. He's a trader from Chicago. We've crossed paths quite a few times, and have never, I think, met. But we know of each other, so looking forward, maybe there'll be a good war story about the floor with Bob at the top of the hour. I know that he's got game when it comes to the market, so looking forward to talking to Bob.
Perfect. Sounds interesting.
And listening to you. So, go ahead, Steve. What are you thinking here? Well, you wrote the blog post on the gold and silver. Did you guys cover? Did you guys cover the gold silver ratio at all in the blog post?
No, but we will be adding to this blog post within 1 or 2 days. But we wanted to take it out since the basic technical analysis part was more or less complete, and the macro part was complete because the metals are on a critical juncture. So more members of the team, as Blake said, are going to be contributing to that. But we didn't want to lose.
That'd be a good thing to cover because I think historically I saw a chart we were near 80.
Yeah, true.
But turn, and historically, really 14. If you go back to several different phases of historically in the economy, I mean all the way back to Rome. Okay, 14 ounces of silver used to equal 1 ounce of gold, and 40 is big money in it if it just corrects back to 40. So just something.
Dale,
I'm thinking, in the silver shares, even though I didn't buy them, they were giving me a hint that the silver shares are looking better than the gold shares, and the silver looks much better than the gold, don't you think? I mean, gold hasn't even broken out yet, and it may be even vulnerable.
That's not exactly like that, because although there is no question that the recent move we had the last couple of days has been stronger in silver than gold, if you zoom out in the chart and you compare the two of them, you'll see that despite of this move, silver has just come closer to a major trend line that might lead to a breakout, while gold, on the other hand, has, as you will see here, has first of all broken a long time ago above a very, very important technical trend line, and has been on the precipice of breaking out of another trend line, out of another triangle. So bottom line, silver has just made a little move to try to catch up with the huge divergence it has been displaying with gold. So silver needs to do a lot more to come to the same position that gold is finding.
That's why the ratio is at such an extreme. So
yeah,
I believe from here on out, silver may outperform on the up days and hold up better on the down days. That's my bet.
That's something that remains to be seen, right?
Yeah. Maybe we'll see it today.
Yeah,
and if I may add something,
you can, Stel, because I know you did about 20 cartwheels with that 40-cent off.
you know, I agree with you. The other thing to remember is that the actual physical quantity of one versus the other, I can't remember the exact ratio, but it's something like 1:6, 1:7, 1:8. So, you know, if you just take the actual supply of physical gold and physical silver, it's much less. The ratio is much lower than the actual ratio of the prices right now. That's why I also think it's gonna revert back to, you know, the gold silver ratio. I wouldn't be surprised if it goes back to like 30-1.
Okay.
You know something, Stelios and Dale, from a technical perspective, I'm gonna tell you that, you know, this might actually happen because I'm monitoring since a long time ago this gold-silver ratio. It's possibly an ascending wedge, as you see here, right?
Yeah.
But last time we were looking at it on the webinar, just to look at my trend line here, must have been at the end of last year. And since then, although somebody can make the exact same claim back then, and this spike that you see up here was that single day that silver had that, what was it, a 2-minute Stelio breakdown, technical breakdown or whatever. It was like a flash crash or whatever that was. So somebody could claim afterwards that, you know, we would finally see this reverse, but it's not happening yet. And at some point, you know, momentum here says that, you know, that might actually end up happening. But in my opinion, unless we see this trend line break.
What a nice 3-driver up here.
Yeah, no, I agree with you. And, you know, this move that we're seeing here, if we zoom in, you can see that the last 2-3 days have been displaying some very strong momentum to the downside. The RSI, after a long time, is finally hitting on the daily oversold level. So this might be a first indication.
Chart on the blog, buddy. In my humble opinion, it's a great chart.
I'll add it afterwards. So
you better, man, or I'm going to have Donald Trump fire you.
Okay.
Right.
Okay. Or I'm gonna just give in my resignation. I don't know. Ashamed and disgraced. So I would be monitoring, the 200 DMA here and this ascending trend line. If we do finally, or when we finally break below this ascending trend line, which acts as support, then I think we can be more comfortable that a big move to the downside is going to follow. And then, and only then, we will have a bigger reason to advocate that, okay, now we have more confidence in saying that if you want to be long one of the metals, you should be looking for silver, while if you want to be short one of the metals, you should be looking for gold. But until then, I think that we do need to keep respecting the fact that, this is still a bullish formation until it's broken, right? So it's going to turn bearish once it's broken, but until then, it's keeping the ratio in an uptrend. So, I think we need to remain a little bit more patient to get more confirmation before we can say that silver is going to overperform. But yes, historically speaking, at some point in the future, and it shouldn't be so far away in the future, we should finally start seeing silver overperform after a long period that it has been underperforming. Now, not much to add here because I already showed this chart. I think that if we finally manage to break above this 1750 area, which is this descending trend line, that's going to open up the 1850 area. So it should lead to at least $1 more of upside. And only when 1850 breaks, then we will finally have a lot of upside potential for silver, since there won't be any real resistance, for at least a couple of more dollars. So I think we need to take it one step at a time. Silver is not yet about to break out, but somebody cannot say the same for gold, which has been testing multiple times since the end of March, the 1355 area. This has proved to be a significant area multiple times. And if we finally see a daily close above 1355, I think that we're going to see some follow through and a move towards the 1405 area. Copper, we've been showing it yesterday as well. Copper is already suffering one more rejection from this confluence of resistances, but it's too early on the day. And even if we have a setback for a day or two, still that doesn't mean that a breakout can't happen. So I've been saying this for a long time now. Watch closely this 317, 318 level of resistance. I think that if we finally close above it, we should see copper extend to the upside once again, because since the beginning of 2016, what we've seen copper do is appreciate wildly on occasion, then go through a period of cool off in a sense, then do the same again, over and over again, rinse and repeat. So this might be another period of consolidation before another push to the upside, right? Palladium is the one that I'm closer in participating in. I have to say, after a 21% correction lower, which was a very healthy correction to a 150% move to the upside, produced an extremely strong move, like 8 consecutive days up, more than 15% appreciation. My stall here, it's the 61.8, but in my opinion, having proven where the strength is by showing momentum again after finding the confluence of supports here, I think that any move down to 1,000 will probably produce a very good buying opportunity. I think that the chances that the corrective move lower for Palladium to be over, I think the chances are very high. So, given the impulsive nature of the reaction from the 900 area, right? So I do think that metals are in critical junctures, and I think they produce opportunities in a period of time, especially during the past 2 weeks. We've seen very low volatility in the vast majority of FX pairs. Even stocks have not been really interesting. I mean, yes, we are certainly seeing a move to the upside, but let's be honest. I mean, it's not it's not like something to write home about. Obviously, volatility has fallen quite a lot, and we're still not 100% sure what's going to happen from here. S&P, which is the benchmark index, remains trapped within a triangle. We might need to suffer more by waiting in a choppy range before we finally see something happening. Now, having to speak about what we think might happen in the very near term, I'm not sure we're going to get a pullback from here. The day so far shows that that might be the case. But even if we do, I would be closely monitoring this breakout level at 26.62. I think as long as we remain above it, in the very short term, we can't call the move to the upside as finished and done, right? So I think now having to do with other major currency pairs, one thing I was monitoring today, and it is interesting, is I was having a look at the Aussie USD. Today's rejection so far from the 200 DMA is the second consecutive we see within like 5 trading days. The Aussie is also holding this descending channel. So although I told you that I'm not ruling out that we might see another move to the upside, we're not getting confirmation yet. So in my opinion, Aussie remains trapped between this 0.7740 area of support. On the other hand, we have the confluence now, because they're now about to confluence of the 200 simple daily moving average and the descending channel. I think that whichever of the two levels breaks is going to show us where the next move is going to come from. I mean, where the next move is going to go to. Is it going to be another push to the upside, in which case I would be looking for the 0.79 area to act as resistance, or is it going to be another push towards a confluence of supports we have at 76.40? This range is now tightening, so I think we should get some kind of a resolution sooner rather than later. On the other hand, Kiwi is showing some more weakness, and that's why we've seen this a very nice technical rebound from a confluence of supports on the Aussie Kiwi. We were showing it last week as well. I know that Blake has been all over it. So, people that are subscribed on ForexAnalytix and you're in the chat with us, you know that it's one of the areas of focus since last week, especially for Blake. We also had patterns in play about it. But regardless, even with Kiwi showing, some weakness from here, I can't say that Kiwi is bearish in any way, because it still remains trapped within a large range between, let's say, 0.7440 and from the downside 0.7180. I do think that at some point, we should get some pickup in momentum and get some kind of a resolution. I wouldn't exclude it to be to the upside, because we came in this range from the downside. So I would still probably slightly favor a break to the upside, even if that's a short-term break. But I have to say that, especially being in the middle of the range, approaching once again the 50 daily moving average, in my opinion, as obviously I'm not a scalper, but from my trading perspective, there is nothing to do here. Just keep monitoring until some kind of opportunity presents itself here. Now, having a Euro USD that is completely range bound, I mean, just look at it. This is the third consecutive spinning top so far that we've seen. So volatility has gone down to zero. But on the other hand, having the crosses, I mean, the commodity crosses move, gives some interest to the Euro crosses. For example, Euro Aussie, you see it here. It's trying to break out from what appears to be a corrective move lower. I think that if we do see a daily close above 159.50, we're going to be confirming at least one more push to the upside. So Euro Aussie is a pair to be watching. Euro Kiwi is also showing a rejection from a very nice confluence of supports. But as I was saying yesterday, there is a chance that at some point we're going to roll over and push once more to the downside. But until that happens, you have to respect that we're trapped between strong area of resistance, strong area of support, currently almost in the middle of that. So bottom line, in the middle of nowhere. Still, I think that you should be monitoring these two levels, because the chances of follow through from breaking of either of those are very, very high, right? And some trades you just have to be patient for. I mean, wait for them. That's why I like to monitor several pairs, because that gives you the opportunity of sitting on your hands on some interesting setups and wait for them while there are other things you can be doing. Pound Aussie seems also to be consolidating within, you can call it a triangle. We didn't violate it on a daily closing basis. Today we were probing below it at some point, but we're now quite above it. This should be considered a bullish formation, a continuation formation, and being in a bullish trend since some time now. That means that the chances of this breaking to the upside and the push towards the 161.8 of the range are quite high. So I'm still monitoring this as a potential bullish setup. And equivalently, you can see the pound Kiwi, which has already made a move. It seems to already be breaking above this a little corrective expanding triangle. For me, key is also this ascending, the intermittent red line you see here, this ascending trend line. quite indicative of the trend remaining to the upside. So I would still be watching for a potential push higher. Now, having to do with crude, I know that Blake showed it a little bit. I need to remind here that we've been monitoring this on a daily basis. We're seeing the move higher. We expected that. Now, we've already, penetrated the 127.2. As I said, for me, the 161.8 is always an ideal target after seeing a breakout. So I wasn't excluding the possibility of seeing a reaction from the 127.2, but ideally I would want to get to the 72 area and the 161.8, in which case I'm going to be very, very happy to see a big reaction, and I'm actually going to be looking to sell into it. So we're not far away from that. I mean, seeing some of the big moves we've recently had in crude, in all honesty, we can even see the 72 level print within a couple of trading days, right? So, my focus here in crude is there at the 161.8. Now, let me have a look of, just briefly to mention that USD yen is still consolidating. I would really not be surprised if I saw another push to the upside, but I have no reason to turn bullish, even if that happens. I mean, even if we see one more push to the upside, perhaps to test this area or the broken trend line support, which might act as resistance, I would still be looking for a move lower until proven otherwise, right? So I can't really say that I can exclude the possibility of moving lower from here, but this consolidation doesn't look that much bearish to me yet. So as I said, one more push to the upside, definitely not out of the question, but I think that this pair is been quite tough to trade lately, so I'm not even looking to be involved and just monitoring it since it's highly correlated with other market instruments, as we all know. That's it more or less. Now let me open the question box and see what our users want to ask, and we take it from there. Okay, Aussie USD, we already covered that. Aussie yen, sure. Let's have a look at the Aussie and the Kiwi yen. Both of them, we warned about it some days ago. Both of them were facing some resistance areas. As you see, the Aussie yen has had trouble penetrating through the 38.2. So, at some point, I was monitoring the 84.40 area actually as a possible area of resistance. We haven't made it there, as it seems the 38.2 has been containing price action for the time being. In all honesty, my first intuition tells me that the move to the upside should be a corrective one. So as long as we remain below 84.40, I would be looking for a resumption to the downside. But we don't have confirmation that has started already. But it's something I'm monitoring closely. And the Kiwi yen, as you see, it has been rejected from a very nice confluence of resistances. It was the 61.8, the 200 daily moving average, and an area that has been horizontal support resistance area. So nice rejection from there. But I have to say that the move to the downside is not persuasive enough yet. That it's a new impulse beginning. So nice rejection, but not sure yet that another leg to the downside has begun. I want to see more price action before I can judge what's happening here. Okay, definitely though, 79.40, a very critical area, holding for the time being. I mentioned the Aussie Kiwi before. Blake showed more or less the same thing. Currently approaching resistance. As he said, this is not the place to be establishing new long positions, but a push lower towards 1.055 or higher than that, 1.064. Those are probably supports. If we do, more importantly, in my opinion, is 1.085. To monitor. It has acted several times as support. Now, inverted head and shoulders on weekly. Yeah, that's old news. Actually, I have to say that the first person that was showing that was many months ago, Gregor. He was showing this inverted head and shoulders formation on the weekly. And yes, the target of that is quite high. It's roughly at $82. Back then, when Gregor was talking about it, it looked like a joke because we were still trading below 50 because he was showing that potential before we even broke higher. So back then, the possibility of getting to 81.5 was looking like a very remote probability. Now, obviously, trading almost at 70 doesn't look that far away anymore, right? So yeah, sure, there is that potential. And let me clarify here because I want to make that very clear. When I said that I'm looking for a short in crude if we push to 72, I did not say and I did not imply that I'm looking for a long-term top, right? But I am looking for a deep correction at some point, and that might unfold from there. So I didn't say that I'm expecting crude to find, a very long-term high there and like push to, I don't know, 20s, 30s, or whatever from there. But it wouldn't really surprise me if I saw a very big reaction from, let's say, the 72 area, which would, let's say, cause crude to tumble all the way back to, let's say, 55, right? That would be a big move. So, I'm looking to trade it. You can call it counter trend, but I do believe that it might produce quite a large move, enough to be totally worth it in giving it a shot. Kiwi, you see the volume spike in July 2017 and the latest huge volume spike, end of March, price continued higher. Any opinion on the next move up to repeat? Yeah, I already covered the Kiwi, Tom. I think that there are, some chances for, there are decent chances for a continuation to the upside. That's what I think. But, we're still in the middle of the range. So I'm not really looking to commit right here, right now. USD-MXN, sure, let's cover it. I don't think something has changed a lot since the last time we saw it. I said that, ideally I would want to see a test of this 161.8 level, and if we do break below that, the next area of support is, the next area of support is quite a lot lower. It's actually at the 1744 lows. Until then, and as long as we remain below 1840, I remain bearish. Okay, I know that we're seeing now a move to the upside, but in all honesty, I'm seeing this as a corrective move. I think that as long as 1840 initially, and then you can even look at the 200 DMA at almost 1850. As long as we trade below those, I do remain bearish. How would the expiration of options today or tonight affect the currency markets? Oh, that's very easy. Very often when there is huge open interest for some specific levels, institutions are defending those levels. So very often you see the market freeze close to large expirations. So that's one way it can affect it. How does the gold-silver ratio affect gold? I'm going to add to the blog post about it, Mazed, actually. So, I'm going to edit the blog post and add that there within the next few hours. Okay, so you can read about it.
You better get that done or the president's going to fire you.
I will, I promise. Hi, Steve, do you have any thoughts on fundamentals for Palladium? No, I don't. Technically, Palladium has been trading in a perfect manner. It's technically extremely clear. And, even if I had, all the knowledge of every fundamental aspect on Palladium, I would still not even try to trade it based on fundamentals because technically it's so beautiful and clean that you don't need anything else to trade it. And, many times fundamentals mislead you because very often the market decides to ignore fundamentals for a period of time or jump the gun and take into account potential shifts in fundamentals. So in my opinion, fundamentals give you only a very long-term direction in a market and definitely not what you need to trade the market. Yes,
Steve, we might as well just mention a couple of things just
Absolutely.
because he's asking on fundamentals.
That's why we have you here.
I mean, the main usage for palladium,
it's catalytic converters.
We don't know. Yes, it's catalytic converters, electronics, electronics, jewelry, dentistry, I think as well. So there's quite a few uses. The main one which has had a big drop is in catalytic converters, because cars are slowly moving to electricity and all that. So it's had palladium has had a jump down mainly due to that, but it still has very widespread use in all other areas like electronics and technology and storage, I think, as well. So fundamentals have taken a hit, but due to the catalytic converters reduced usage there. But still it's a metal which has plenty of uses. It has very
also we have to take into account here that yes, most precious metals have been in an uptrend since the beginning of 2016, and we are fully aware that the dollar started plunging at the beginning of 2017, so that was a year later. But definitely, at least for the last year and almost year and a half now, the dollar's move, which has been in a clear downtrend, the dollar has definitely added fuel to these uptrends, right? Because when we're viewing these commodities, these metals in this case, we are looking at them versus the dollar. So obviously that has played a huge role as well. So whatever the dollar is going to do is definitely also going to affect, the technical picture of these metals.
Yes,
so
we do mention this on our blog post, so it's
absolutely
worth checking out.
It's worth checking the blog post, and as we said, we're going to be adding to that during the next few hours. Greg and Andrea are also going to be adding, some things from the aspect of harmonics and Elliott waves equivalently. So it already has enough content for you to read, but we're going to enrich it during, let's say, during the next 24 hours. So it's going to be even more content there for you to read. Okay,
the White House is watching.
Okay. Abdul, I did cover pound Aussie and pound Kiwi, mate, a few minutes back, so you can see the recording. I covered them like 10 minutes ago, maximum 15 minutes ago. Let's have a look. I have a last question about the Nikkei. So let's have a look at the Nikkei. And we had a question about the Nifty, so I'm going to show that as well. Nikkei seems to be getting rejected for now from the 50% fib. As I said, we are, in the middle of this range. In all honesty, I don't have, such a clear bias here. I mean, I can't exclude anything. I've told you since a few days ago that almost all indexes are at quite tough positions to read, because, you can't exclude the possibility of seeing more downside or having found a tradable bottom. The thing that is going to give us more conviction about that is going to be the nature of the pullbacks we're going to be seeing to these moves higher we've had. So let me be specific. If whenever we get a pullback, let's say it starts today or it starts next week, it doesn't matter. The nature of that pullback, is it going to be corrective or impulsive in nature, is going to give us more information to be able to look forward in a longer term prediction than we can currently make. Okay, so that's very important. You need to be patient here. I mean, this is not an easy to read price action. It can be interpreted in multiple ways. So, we need more price action to be able to say. And having to do with the Nifty, if you remember, I think last time we covered that, I was in Rhodes. I told you that it found the bottom where, it's okay to find the bottom. Since we were expecting one more low, we saw that. And I told you back then that 10,600 is a very critical level. We seem to be getting rejected from it as we speak. I think this is the area that will define, call it the bull bear line. So 10,600, I think, is more or less the bull bear line for the index. If we push through it, I think the chances that we found a tradable low are very high. If we get rejected from here, I'm going to once again repeat what I just said. I want to see the nature of the move lower after a rejection, and then we can have more confidence of what's happening here. Okay. So thank you, Dale. I don't want to bleed into the interview. we're going to be here tomorrow once again. I think Greg is going to be with us tomorrow as well. So if your guest is here.
Okay, thank you, Steve. Nice job, Steve, Stel. Everybody stand by for Bob Iacchino. I'm looking forward to speaking to Bob. It's my Chicago trading warrior brother. So Bob, I just passed you the ball. Hope you handle it better than the Bulls do. I don't know how the Bulls are doing. They're even in the playoffs. So waiting to hear your voice, buddy, and share your screen.
The Bulls are done, Dale. Can you hear me?
Got you, Bob.
The Bulls are done.
Okay. They haven't had a team since Jordan anyway. So Bob, it's really great to talk to you because I don't think we've ever met, but I know that our paths have crossed many times because you're familiar to me. I recognize you. I'm interested in your journey, and maybe there's something in common there. Were you in the business when the old Merc was above Union Station on Riverside Plaza?
No, that actually predates me. Not because I'm not old enough to have been there, but I was in a different industry, which is kind of
okay.
It's one of the interesting parts of my story. And yeah, I mean, I'm surprised as well. And I will be very surprised if at the end of this, we don't talk about 25 mutual friends in 15 different places we used to frequent at the same time.
How about stumbling around on Rush Street?
Oh,
Maybe
absolutely.
Okay.
Absolutely. Ever since the days of a fake ID, so a long time ago. The days when you could go to it. We won't get in trouble for this, but the days where you could actually go to the DMV with your older brother's credit card and his social security card, and they'd give you an actual ID with your picture and his name. That's the way we used to do it.
Okay. All right. So you started in a different industry when I was a runner on the floor. So how did it happen for you that you ended up getting into the trading business?
I always think this is super interesting because one of the things that I miss about the actual trading floor is there's less opportunity now. There's still some, but there's less opportunity now for a person to get into professional trading from nowhere, right? From not having gone to an Ivy League school or been at the top of your class at a Big Ten school or something like that. Because what happened with me was my family actually had an Italian bakery when I was growing up. The original place was in Elmwood Park. The second larger reiteration of it was in Franklin Park, and I drove.
was going to say Melrose Park because
yeah, it was
I know
one of the parks.
It's an enclave for Pisons.
It is. It's one of the parks here in Melrose Park, Stone Park, Elmwood Park, Franklin Park. It's all the parks. Okay. So I worked there. I drove a bread truck. I started working there when I was 11 years old. And what ended up happening is my father brought on some partners to expand the business, and they teamed up with a silent partner and threw my father out. So my entire family worked there. It was a growing business. It was about $4.5 million in sales. But if you know anything about food, you got about a 1% net profit in food. So it's not a ton of money for a bunch of families to live off of until you get to about 40 or 50 million. Having said that, I reached head of sales there when I was 19, which you can get through nepotism. But when my father brought in these partners, they essentially threw him out. So my entire family left the company, and I was sitting around unemployed for the first time since I was 11. And a friend of mine who worked at the Chicago Mercantile Exchange said, "Look, you're not doing anything. Why don't you come and hang out with me?" And I said, "Where?" And he goes, "Well, I work at Chicago Mercantile Exchange. I'll get you on the floor." I said, "Great." And I actually thought we were going to the merchandise mart. I had never heard of the Chicago Mercantile Exchange in my entire life. I went down there, fell in love with just the sort of vibe of it, the activity, quite frankly, the testosterone, the screaming and yelling. I'd been an athlete all my life, but as a 5'9" Italian, it pretty much ends after junior college. So having that whole experience, I felt like this was the closest thing you could do for a living to playing sports and possibly make a good living at it. So
did you start as a runner or a clerk?
I did. Well, I started as lower than a runner. The next day, my buddy invited me back, or I asked to come back, and I walked around begging for a job, and I got a job with a guy who told me my entire job was to get him coffee in the morning, get his lunch, and look for another job. He did not want me. He had no work for me. He just took pity on me, and that's what I did. And he told me if I ever got sprouts on his turkey sandwich, I was fired that day. So that's how I got my start down there. And it ended up, I started out from there as a trade checker / runner in the yen pit. And then I went into the Eurodollars after that. And I spent time at the CBOT. I ended up being an assistant strategist at a Japanese firm. And then I went from there to being a chief market strategist, briefly at Smith Barney, and then at a German bank called Commerzbank, which is still in existence. They were Germany's 4th largest bank at the time. I think they're 6th now or something. But they're still in existence, and that's kind of how it happened. It all went downhill from there.
Yeah, and you're also a contributor on CNBC on Futures Now, so I've seen you there. And why don't you tell us a little bit about what you're doing with your latest creation at pathtradingpartners.com. I went there. It looked like you had a lot of information about cryptos, but you have Canada up here. So why don't you tell us what you're doing there, and maybe even go over your setup, what your vertical dotted lines mean to you, cycles, etc. Tell us what you're thinking about Canada and what you're doing with your new venture.
Well, so the Canada chart is a pretty good example. I'm going to go over Canada, and then I'll go over the yen as well. But what Path Trading Partners is a boutique analytics firm. We actually do in-house white label analytics for several institutions. Smaller institutions, it might even be a stretch to call them institutions, but when they need either geopolitical or technical price analysis or even fundamental analysis, we do it for them. So one of the clients that I can mention is a company called Basis Capital, which is an overseas FX cash broker. They do over the counter, they do CFDs, they don't operate in the US.
Okay.
So that's one of the firms. And then I do some things for the CME group. I do some things for the North American Derivatives Exchange. And Path Trading Partners is sort of the company that represents that. You see cryptos on there because I also am a part of a company called blockfills.com. Now, the .com is just to give you their website. It's blockfills.com. But what Blockfills is, again, it's a boutique shop where we do large-scale crypto buys and sells for high net worth individuals and family offices. So the minimum account size at Blockfills is 50,000 US. So we do a lot of crypto analysis for free, though, on YouTube through Path Trading Partners. So we are big believers in cryptocurrencies as an asset class going down the road. I don't like to particularly talk about which crypto I like because I think, personally, I think Bitcoin is MySpace. I think there's a Facebook that's coming. I think there's going to be a cryptocurrency that surpasses Bitcoin and actually is more effective than Bitcoin. But for now, Bitcoin is the king, and just like MySpace was for many years, when Rupert Murdoch bought it for $600 million and it subsequently went to zero.
Does this crypto phase that we're in, Bob, with all these ICOs and a lot of them are junk, remind you kind of the dot-com phenomena going into 2000 where there was a lot of trash, but after the dust cleared, we ended up with giants?
Yeah, very much so. I mean, people talk about cryptocurrency being the internet bubble. The whole blockchain is the internet. That's the way I look at it. The blockchain technology is the internet. People can fight it as much as they want, but blockchain technology is going to take over 85% of what we do in our daily lives. Cryptocurrencies themselves may or may not be valuable going down the road. I personally believe more in cryptocurrencies that have an infrastructure around them. So in other words, they're a unit of barter, so to speak, within a universe or an infrastructure. So there's places that are doing that with, for example, venture capital. There's places that are doing it with medical information and medical purchases where they have their own coin and you can be in their network and use their coin to purchase prescriptions and things like that. Those are online. Things like that, I believe, are going to survive. So yeah, you're going to have the best thing that can happen to the altcoin space right now is actually punishment for some of the crap. And the SEC is starting to come down on that. They're probably going to start next month from the people I talk to, that they're going to start coming down really hard on fraudulent ICOs. And the ICO is an extremely valuable tool, and I'm a huge fan of it. It's just a lot of people don't either have the ability, the time, or the desire to do the due diligence you need to do to get involved in a correct ICO.
You know, some of these ICOs remind me of like pink sheet stocks,
Agreed.
bulletin board, and I'm wondering if they're going to do the same thing that IR, investor relations firms, did for pinks, where you actually pay people to come in and produce volume so that you can unload some of your paper.
Well,
are you seeing any of that in the crypto space?
Yes, and that's an excellent point, Dale. I hope your listeners appreciate you bringing that kind of thing up, because again, when I say you don't have the time, the ability, or the desire, by ability, I don't mean you don't have the brains to do it. When you look at somebody like Kyle Bass or Carl Icahn, or these guys that go in and they buy a bunch of shares of something, or they get shares in an IPO, that's because they've actually gone to the company and watched operations. You know, you'll hear some of these larger firms, especially with their analysts, they say, yeah, we went in, we talked to the managers, we toured the factory. We don't have the ability as everyday people to do that, and no one's going to let us in. So if you're looking at an ICO that's based in, I don't know, the Ukraine, you're not going to be able to go in there and see if they actually have the operations they're saying. But people get so caught up with this idea that they're going to buy at 0.2 cents and sell at 1 cent. You know, and make 80% on their money. It's just, it's too tempting for most people. And I would advise that people stay away unless there's a reputable person involved.
That's probably the spread, 2 cent bid, 0.2 bid, and one offer.
One offer, right.
And the market maker makes 0.8 cents.
Right. So, I mean, unless there's a reputable person involved who stands to suffer reputational damage, public reputational humiliation, or you can actually go see what's going on with that, you should probably stay away from ICOs, wait for coins to get established, wait for them to be vetted by institutions and professionals. Right.
Great advice. All right, let's get back to the loony here, buddy. I do tangents in my interview.
It's okay, I love tangents.
Okay,
so fan of tangents.
Okay, so what are you seeing here? Canada, you know, a lot of people thought that rally to 131 was going to be a failing rally. It turned out, you know, a lot of Canada bulls or USD CAD bears are looking for lower levels. Crude's been strong. Do you include what's happening in the oil market because Canada's a natural resource currency do you use that correlation to trade it, or trade it as an individual entity?
Well, so crude is one of my favorite things to trade. It really is. So I don't particularly care for correlations that much unless you're in a situation where the margins on crude oil futures is too high. And then you can go and look at something like Canada. But I would caution people down the road that unless we build more pipelines in the US, I spent 2 years in an actual physical crude oil firm deliberately because I love trading crude oil so much that I wanted to learn more about the physical side of it. And crude oil travels down a pipeline at about 11 miles an hour. And we don't have enough pipe to take advantage of all of the oil sands in Canada that they're pumping up right now. So there's a lot of storage there. And the spread between WTI and actual Canadian crude, which used to be just the cost of the pipe, and that's it. That's
it's all like $10, $20 discount up there, isn't it?
Exactly, because they have to allow for people to pay for the cost of the pipe. And the cost of transport generally. So what you do when you buy Canadian oil is you pay a price minus pipe. That's what they call it.
Interesting.
But pipe can be a railway, it can be pipe, it can be whatever kind of method you can get. It can be trucking, which is not used anymore, but any sort of shipment. So when you're talking about Canadian oil, you might end up in a situation where crude oil continues to rally and Canada doesn't, because you have too much of a discount for the Canadian producer to continue to pump. Just simply because we don't have enough pipeline. And you saw CSX yesterday, which is a train company.
Right.
They ship a lot of oil. They doubled their profits from the last quarter. That's unheard of. And that's because of the demand for rail cars to ship crude oil. That's one of the main reasons. So as the crude oil price goes higher, they want to pump it out and they want to deliver it. So it's an important distinction to know that. So for me, I know the trade is crowded, but I remain a dollar bear simply because of this. And that's part of the reason I pulled up the Canada chart, and I want to pull up the yen chart as well. the dollar is driving these trades more so than the economies of the underlying countries, which is often the case. I'm not telling people anything they don't know. So what I look for, I'm going to give people a little bit of, the moving averages you see up here is the 50 exponential, the 8 exponential, and the 21 exponential. And I use those for a very specific reason. When the 8 and the 21 are in a steep downward angle like this, we call this a rotation zone or an R zone. And if you go to Path Trading Partners, there's actually a course there. We don't sell a lot of education, but we do have it available. I think we sold maybe 10 last year. We don't really, it's not really our business. But people ask us and we don't really have time, so we put it up there. There's a course called the R Zone in our store at pathtradingpartners.com. This is the R Zone. So what we look for is we look for a first cross, which we got right here. I think you can see my cursor, right?
Yeah, got it.
Okay. And then we get a rotation up there and a sell-off and a rotation up here, and I'm expecting another sell-off. You're seeing the moving averages starting to flatten, and we have a way of looking at that. Now I have the 50 up in here because oftentimes what happens on the third or fourth cross, if we come off of a choppy period like this, is the 50 will cause resistance to cause us to go back into the R zone. So what I'd be looking for here is some sort of best fit trend line at an angle like this, and I'll just kind of draw one here for now. It won't be the exact one I'm looking at because one hasn't developed yet. But I'll be looking for a best fit trend line that fits right around here somewhere. And if I can get a full rotation into here and then a break of this trend line, I'll go short again on the dollar Canada. All right. So that'll be the kind of thing I'm looking for. And what I do, Dale, is I have a fundamental opinion about something, and then I look for price action to support it. If I don't have a fundamental opinion, I'll still trade the price action if it's perfect.
Okay, well, you know, that's a great segue because a lot of people have been fooled by dollar weakness during a rising interest rate environment. They're saying, you know, everyone, we had a, you know, down 12% dollar last year. It's not doing, you know, not bouncing at all with what the Fed is doing. How do you explain that correlation with the dollar being weak with rates being higher here than anywhere in the world?
In the medium term, the dollar will be driven more by longer term rates and inflation than it will by the Fed. Believe it. Now, in the short term, it gets driven by the Fed. The Fed is on a 3 rate hike path for 2018. 80% of the members of the Fed voting team, as well as their the non-voting members, believe that 4 rate hikes in 2018 is more likely than 2. But they're still on the path of doing 3, considering they've already done 1. Okay. So what we're missing though is inflation, and that's why you're seeing the yield curve start to flatten.
Right.
The longer term, the longer term rates, there's an issue with the longer term rates right now, and that's that there's no inflation. We've seen the yield curve from say 2s to 30s go from 80 to 70. We see 2s to 10s go from 61 to 50. That's a scary situation, and something has to give there. And if the economy slows down, what gives is the path of rates by the Fed. That's what gives. So the Fed will back off.
Any thoughts on the squeeze that we've had in LIBOR? And remember, in the old days, Bob, we'd have the TED spread to tell us, give us market messages about flight to quality. And during the recent equity sell-off, we really saw no flight to quality into bonds, and LIBOR has been really squeezing people. I mean, hasn't it tripled in price in the last 6 months?
It has. LIBOR to me is more of a technical function. It's more about the lack of lending and credit that's going on, and it's part of the reason. So I don't particularly pay attention for our purposes, but part of the reason it's happening, I was talking to a friend of mine who works at Mitsubishi, and he was saying to me that they are struggling almost every day to do just their regular funding. So it's more of a function of that, and LIBOR is going to suffer because of it. The Fed just came out with SOFR, which is a new version of this sort of intraday and monthly rate. And now they found a technical problem with that. The whole reason for that was to keep LIBOR in check, and now they have a technical problem with that. So I think it's more about the banking system fixing what's going on with LIBOR right now than anything economic that it's telling us.
Because doesn't it mean that banks are unwilling to lend to each other, and that's what's forcing LIBOR?
Correct. And again, that's a credit function. And the reason the Fed is getting involved is because they did their bank stress test and they say everyone's okay, but bank to bank doesn't buy it. And
Yeah,
we're seeing subprime come back. I'm sure you've heard about that.
That doesn't do a lot for money velocity.
Exactly, it slows it. So,
Right.
and again,
okay.
No inflation, right? So generally inflation is driven by the velocity of money, not necessarily the amount of money, but how quickly it's moving, and it's not moving.
Right. Okay, so we're looking at the yen here. Are we in the, I see the line flattening here, and kind of a similar situation to what you had in Canada. So you have that little uptrend line. You would now wait for a break of that trend line to enter short positions?
Yes, so what you're seeing,
a rally?
I would initially sell a rally against this area, probably if we get a pop above, and get out above the 50. But my normal entry is going to be a break of this trend line. I prefer if it goes up in here and tests, but this, what I call significant level right here, which generally, just for a quick explanation of what we call significant levels, it's a repeated test of a level by emotional candles. And these are emotional candles. Okay, something like this, something like that, something like these two right here, V-shaped reversals, things like that. I don't just do typical support and resistance, as you know, you can find them every 20 cents. So I look for something more significant, and I look for it to line up with the R zone. That's why I wanted to start out with the Canada and then switch over to the yen, because right now it is, this significant level here is lining up with the R zone. So I don't like that the R zone is flattening out, so I won't sell this rally. If it were still a steep R zone like it was here, I would. So what I'm going to look for is a test of the significant level and then a break of this trend line. This wick right here is enough of a test for me. Okay. So if we get through this trend line, I'll have a first target right in here. Okay, and then I'll have a second target down at the end of this move right down here.
Okay, so yeah, you know, I don't know if you went through it, but you know, we all, I always tried to get the edge and get the best price, but I've learned over the years that better to be a little late and have confirmation than try and top pick or bottom pick.
What's interesting, Dale, it's something I come across a lot. I'm glad you brought that up. By the way, this is a weekly chart, so this would have to be a Friday close.
Yeah, I noticed you brought your telescope.
Yeah, and the reason is, and you just kind of hit on it. Ever since we've had HFT, okay, and I do a lot of work with the CME group, right? I speak on behalf of them, and you know, I talk to those people a lot. Yeah. So, sorry, I just hit the cough button there. I'm playing a little hurt today. Okay. There is an absolute unbelievable amount of high frequency trading that goes on in futures and FX and in equities. Everybody knows that. The way to beat them is not with 1 minute bars or 5 minute bars. It's not to try and beat them at their own game. Okay, that's like going in with Mike Tyson in his prime and trying to outpunch him.
Yeah, that's a pearl.
It's just not going to do it. So what I have found over the years, and I left the trading floor in 2003, moved out to Los Angeles, and reinvented the way that I trade strictly for this reason, because you know, Dale, you used to be able to hear things and know what to do without actually knowing what was happening. You'd hear a certain sound from the roar, or you know, just cells.
When they were electing stops.
Exactly.
Yeah.
So I wanted to get away from the trading floor and get away from that stimuli and figure out a different way of doing things. And what I learned is that the more you shrink your position size down and pull your duration out, so lengthen your duration of trades, the higher your probabilities go, the higher your win percentage goes. So that's really one of the biggest things I can tell the retail traders. Stop thinking that I want to trade for 2 hours in the morning and then I want to go to the beach. It's more about I want to put on 2 or 3 trades a week and then go to the beach. So for me,
let your trades breathe and reduce leverage.
Exactly.
I mean, I say this, Bob, if you can't be wrong for a day, how can you be right for a week?
That's a great line. So I might sell this around I don't know, where are we at right now? So I might sell the yen if I get a Friday close below this trend line, and that might be as far as about 106.5. And I might hold that all the way until about 112 before I get out of it. But what I'll do is I'll have a small size. You know, in FX, we can use the micro lots and the FX cash.
Right.
And people get sort of, they get offended by the micro lots, but I can do 1,000 micro lots. It doesn't bother me.
Point.
I mean, it's like what? It's just like going into the gym and lifting too much weight and hurting your tendons. It's just silly. So
yeah, do more reps instead of maxing out.
So I would rather have 9 different positions of 3 to 10 microlots each that are going to all last about a week to a month than try and get in and out over 2-hour sessions and just get myself chopped up.
Okay, Bob. Bob, you know what I'd like to wrap it with, since, you know, the S&Ps have been a one-way train for a long time up until February, and we had that big break, and curious as to what you think is going on here. I do know some people that are, you know, say the bull market has another 1 or 2 years to run, maybe until late 2019, and they're looking for much higher levels, some, you know, up in the 4,000 range. Do you think that this double bottom has to be taken out before the bull market reasserts itself, or are we just going to go from here? And what are you telling people now that, you know, I was trading bearish ETFs, and the last month or so, I really can't stomach having a good close by, you know, the regular session, and then having headline risk take the S&Ps down 40 handles based upon a tweet or a report by Mueller or anything else. I mean, the overnight action is just, you know, I can't stomach it right now. I'm doing other things. What's your view on this for longer term investors?
So I'll put it this way. My role is not to be political. My role is to analyze what the politics means to the market. So
exactly.
Having said that, I'm not going to give my opinion of this particular president because it's not important. What one of two things is going to happen. There's either going to be a result from this investigation or there's not. As long as this particular president is in office, I'm going to say the S&Ps are going to make a new high. I'm going to add on to that I think 2018 finishes positive either way. There's a set of 3 circumstances that over the last 50 years has caused a positive S&P at the end of the year 48 times. 48 out of the last 50 times that this 3 sets of events have happened, we've had a positive finish, and that average positive finish has been up 11%, not adjusted for dividends. So I'm going to go on record as saying the S&P will be higher at the end of the year than where it opened. Now, you guys got to remember, it opened, we're up on the year now, right? Because here's December. Right? So we're now finally back up on the year. So that's not necessarily saying much. We don't have to make a new high to be up on the year.
Right.
But if for some reason President Trump is out of office, part of what's driving the equity markets, obviously, it's threefold. It's been easy money from the Fed. It's been regulation being pulled back, of which there have been a ton. It doesn't get mentioned enough, but a lot of regulation has been rolled back. And is the tax cuts for the corporations. Whether those things are ethically or morally correct doesn't interest me. It really doesn't. But that has been driving stocks higher. It's driven earnings to what we're going to get about a 20% blended earnings growth rate this quarter. That's huge. I don't know that that's repeatable, but it is very big. And so at the end of the day, stocks trade off of earnings. Whether that helps Main Street or not is, again, I don't say this in a cold-hearted way, but it's not of interest to me because it's not my job. I'll talk about those things at dinner with my friends and family. But this, for our particular purposes, if President Trump remains in office through 2018, and it does not look like he's going to be impeached or thrown out of office or even arrested, equities will be higher. If that flips, the tweets and all those things, they're short-term. You should buy dips on tweets. Unless a tweet is like, you know, I wear a large in my prison robes, that's a tweet you should pay attention to.
Okay. Well, yeah, what a great interview, Bob. You know, I'm so glad that you accepted my invitation. You know, I knew you were going to be a guy I could talk about any market with, that you'd have everything on your radar, and really appreciate your time today. And now that we've met, you're my trading warrior brother. I'd love to do this again down the road. You want to show your website?
Sure.
Before we, you know, say goodbye, so people know how to get a hold of you. I know that Bob's Twitter handle is at Bob_Iaccino. That's IACCINO, and his company is at Path PATH_trading. So if you want to show your website,
sure.
I'm going to show you.
I'm going to show you 3 websites in 2 quick seconds if I can.
Go.
So here's Path Trading Partners, and here is all of the cryptocurrency stuff. My partner Mike Arnold does these videos, and he is way better than me. I'm not kidding. In terms of price action analysis and stuff, the guy is absolutely just deadly. He's so good at it. Mike is he's got a heck of a resume. He's a hedge fund consultant. He was a market maker at the CBOE, and he also helped start the Swiss options exchange down in Switzerland. So he's just got a ridiculous resume. He's an absolute trading robot. So this is Path Trading Partners, and here I said if anyone is interested in the store right here, the training of the tools, that's where you get it. We also have a podcast called the Money Path Podcast that we record. It's released over the weekend. It's very free flowing. We're not very strict on it. We pick on Elon Musk quite a bit. Then I'm going to show you this other site called trendytrade.com, which I'm also a part of. This is aimed more at millennials, but this essentially is we assign a bullish or bearish score, and we have all markets on here. We have Forex, we have stocks, we have commodities. If you go to FX, you'll find cryptocurrencies on here as well. This is an infographic style. So if you go to, let's say Procter & Gamble, for example, you click on it, and it's every bit of information you need on the stock, where it is overpriced versus their sector, all the tweets, all the twits. One of the things I find interesting here is the seasonality factor of stocks and commodities. It's something that, if you'll indulge me for 2 more seconds.
Yeah, go ahead, buddy.
If I put crude oil in here, for example, this has been one of the things that has baffled a lot of people. But if you see any of my TV interviews, you'll see that I've talked about this quite a bit. Let me just go to the commodities.
Do you think there's a hot conflict brewing in the Middle East?
I don't. Okay. And I'd go a little bit too much into conspiracy theories if I told you why. But I believe that things like the missile strikes are pretty, they're pretty accepted by everyone. It's not something.
I just was kind of thinking that Iran, quiet things down with North Korea, have a deal because we couldn't deal with both of them.
Mm-hmm.
Decertifying the nuclear deal, having a guy like John Bolton in the cabinet, a lot of hawks, and the President Trump's first visit was to Saudi Arabia. They're fighting a proxy war in Yemen, and more and more action in Syria between Israel and Iranian forces. So I don't know.
The reason I say no to that is not because I disagree with anything you've just said. I just think that when you get the 3 powers, China, Russia, and the U.S., when there's an attack, all 3 know about it. It's kind of cleared with everybody is the way I look at it.
Right, okay.
But it definitely could spark. I'm more worried about Yemen, Saudi Arabia than anything else.
Yeah, okay.
So what I wanted to show you is I unchecked everything except commodities, and I went to the crude oil page here. You can see that the sentiment is 73% bullish based on news stories, stock twits, Twitter, everything that's out there. But look at the crude oil seasonality. This is something I've been talking about on my TV interviews, where everybody has said shale is producing, but this is 20 years of seasonality, and this is very steep because crude oil almost always goes up during this time period.
Driving season.
Yeah. So, and then the last one I'll show you real quick is the block fills. Again, this is more about family offices and the like, but this is the other company where you guys could find me. Essentially it's over-the-counter cryptocurrency trading for high net worth. So the Path Trading Partners is where you guys can reach me if you want to hit, remember, support at pathtradingpartners.com. That's where you can email me, or you can hit me up on Twitter anytime you guys want.
You've got all bases covered, buddy. Go Cubs.
Go Cubs. Let's get them going again.
All right, buddies. It was great talking to you, Bob. I hope that pips rain down on you and your partner and everyone you do business with. So
happy to be here, Dale. I appreciate it.
Thanks for your time, Bob.
Cheers.
Good hunting, my trading warrior brother.
Appreciate it, Dale.
Remember, above all, don't just count your pips, count your blessings. You're welcome, Kareem. You're welcome. I encourage you to follow this gentleman. He's Chicago trading warrior brother, and if you listen to him, you probably learned and were edified today. So see everyone tomorrow for TGIF. Thanks again, Bob, and enjoy the rest of the day, everyone. See you tomorrow.